Welcome everyone to the second video in our series 5 of the video tutorials on some of the most commonly used MT4 indicators. In this video, we will be covering the MACD indicator. So what is MACD? MACD stands for Moving Average Convergence-Divergence. It is a momentum-based oscillator. A momentum-based oscillator gives an estimate about how quickly the price changes from highs to lows. Therefore, MACD, being a momentum oscillator, takes into consideration two moving averages and determines the magnitude of oscillation between them as an indicator of the direction of momentum. So how does the MACD indicator work? As mentioned, MACD takes into consideration two moving averages. These are mostly the exponential moving averages. One is for a shorter time period and the other for a longer time period. The shorter time period exponential moving average is known as the fast EMVA or the fast moving average, and the longer period one is known as the slow moving average or the slow EMVA. This is because the shorter period EMVA or the moving average is able to reflect the change in price moves quicker as compared to a longer period moving average. Now what this indicator does is that it subtracts the short period moving average from the longer period moving average value and plots this difference around a baseline. The baseline is set at 0. Then, based on the value of this difference between the value of the two moving averages, it oscillates above or below this 0 baseline as the two moving averages which have been applied on the chart converge, diverge, or cross over each other. Since the MACD is the value of the difference between the value of the two moving averages, therefore it can either be positive or negative. We shall consider each of these scenarios one by one, starting with the case when the value of the MACD is positive. A positive value of MACD implies that the shorter period EMVA or the exponential moving average is more impactful than the longer period EMVA and is trending above it. This value of MACD becomes more positive as the shorter period moving averages divergence above the longer period EMVA increases. This divergence is indicated by the move of the MACD above the 0 baseline and is an indication that the upside momentum for price movement is increasing. Next, we have the case of a negative value of MACD. A negative value of the MACD indicator implies that the shorter period EMVA or the shorter period moving average is less impactful than the longer period moving average and is trading below it. This value of MACD becomes more negative as the shorter period moving averages divergence below the longer period moving average increases. This divergence is indicated by the move of the MACD below the 0 baseline and is an indication that the downside momentum for price movement is increasing. Let's have a look at the trading platform itself about how this works. We consider applying the MACD indicator on the Aussie dollar chart. To insert the indicator, click on Insert and select Indicators. As you can see, the MACD would appear. On selecting the MACD indicator, the pop-up window appears. You need to input the MACD parameters, the fast EMA or the exponential moving average, and the slow EMA or the slow exponential moving average. As you can see, the fast EMA is a shorter period EMA, which is 12 over here, and the slow EMA is a 26 period moving average. Having selected these parameters, click OK. You can see that the MACD indicator has been applied at the bottom of the chart. The dotted line is the MACD indicator. As you can see, it is moving above or below the zero baseline. To see how consistent this is with the moving averages, we shall apply both the 12 and 26 period exponential moving average on the chart as well. Select Insert, Indicators, Trend. So we have the 26 period moving average and the 12 period exponential moving average. So the moving average, which is red in color, is the 12 period moving average, and the purple one is the 26 period exponential moving average. As you can see, whenever the shorter period moving average is moving below the longer period moving average, the MACD is also below the zero baseline, since the value of MACD would be negative. Similarly, whenever the shorter period moving average is above the longer period moving average, the MACD corresponding to that is positive and above the zero baseline. Now, whenever the two moving averages of the MACD indicator cross each other, it is generally considered as a trade signal. Each crossover of the moving averages among each other is represented as a crossover of the MACD indicator above or below the zero baseline. If the MACD crosses the baseline from above and moves below zero, it is considered as a sell signal. Correspondingly, the shorter period exponential moving average, or the shorter period EMA, would have crossed the longer period EMA from above. Similarly, for a buy signal, if the MACD crosses the zero baseline from below and moves above it, it is considered as a buy signal. Correspondingly, the shorter period moving average would have crossed the longer period moving average from below. Let's have a look at this on the platform. Consider this point when the MACD crosses the zero baseline from above and moves into the negative territory. Corresponding to this crossover, we see that the shorter period moving average is also crossing over the longer period moving average from above. This is what is considered as a sell signal. You can see that the prices have been trending lower since the crossover took place. Similarly, at this point, where the MACD is crossing the zero baseline from below and moving towards the positive territory, correspondingly, the shorter period moving average crosses the longer period moving average from below, and the subsequent price movement is an uptrend towards higher price values. This is considered as a buy signal. In addition to the two moving averages, you would have noticed there is another parameter which often has the value set at 9. This is the MACD SMA, or the MACD Simple Moving Average. It is a 9-period simple moving average of the MACD value itself. It is a simple moving average which is calculated by taking the arithmetic mean of the past 9 values of the MACD indicator. This SMA helps trail the MACD better and makes it easier to identify the crossovers and bends. If the MACD crosses the MACD SMA line from below, it is considered as a buy signal, whereas if the MACD crosses the MACD SMA line from above, it is considered as a sell or a bearish signal. Despite its popularity as a widely used indicator, there are few drawbacks of using this MACD indicator. Firstly, it is a lagging indicator. What this means is that it uses the past data to predict future price movements. As a result, it lags the price action, and therefore, generally, the trade signal would be generated after a significant move has already taken place. Moreover, it often generates several transaction signals within a major trend move. This could often lead to overtrading and unnecessarily losses. Another major drawback is that this indicator can change the direction very quickly through its crossovers above or below the zero baseline, resulting in some false trade signals. With this, we come to the end of this video tutorial. Hope you enjoyed this video. Thank you for taking the time out.